Good afternoon, ladies and gentlemen. I certainly do appreciate you taking the time to join me here this afternoon. My name is Chris Swift. I'm with Swift Trading Company. I'm a commodity broker and analyst, a GIB with Rosenthal Collins Group, and daily I produce a couple of market commentaries, Shooting the Bull, and the Midday Cattle Comment. I want to thank Chris Winward, my associate, for helping me. A lot of you have talked with him over the past couple of months. He's done some awesome, good work for me here, and hope to be able to have a good presentation for you this afternoon. Today we're going to discuss the fifth wave, and the reason that I am doing this is because so many of you have asked a lot about the Elliott wave, and it is very difficult to try to interpret, and it is clearly subject to interpretation to each and everyone's opinion of how they look at the markets. The Elliott wave, what I try to do in this situation is look at what the fundamentals are, and the Elliott wave represents the actions that people take in that. And in some degrees, they take greater actions, and in lesser degrees, they take lesser actions, and they form what considers to be the wave count. And really what a lot of that wave count is just the recognition of people's habits. People tend to be very habitual in the things that they do. We all brush our teeth, comb our hair the same ways every morning, and so therefore we become repetitive, and trading is no different. We tend to do the same things. If we are profitable in our trading, we tend to do the same things over again. If we're not very profitable in our trading, we still tend to do the same things over again. So the Elliott wave, depending upon what magnitude the wave in, is a representation of what traders are doing and how much they perceive the market going to move up or down. The major wave count, of course, consists of 5 waves up and 3 waves down. And this major degree can be most any time span that you wish it to be, and more often than not, we tend to look at the weekly and daily charts for timing because they are more prevalent than something along the monthly lines. In cycles of cattle and grain production, there are much tighter time frames than what the monthly charts may provide. The next degree is the intermediate degree, and you can see it puts a whole lot more numbers inside of the major wave count 1 through 5 and the ABC down. It's those lesser waves that we try to anticipate and see what may transpire next by the waves that have already taken place and what is normally anticipated after those waves have taken place. What does one anticipate next? And you've seen me write a couple of different times. The next most probable move should be X, Y, or Z. And that's where I determine that from, is after the markets make a particular move, then they are noted to make another type of move afterwards. And after if the prior move is if the prior move is correct and we're able to analyze the prior move correct, then the next most probable move should have greater odds of succeeding. The minor degrees are the smallest degrees, and we're going to get into this really hard and heavy when I get to the cattle market, because that's where a lot of the importance is. Trying to find a bottom in this cattle market to give a little bit of relief to some individuals out there. So this is the daily chart, weekly chart, continuation of live cattle. It's a close only, so you don't see all the noise within the week's time frame. It's based only upon the close. And you can see that I have the numbers written up there, and those are my numbers. That's my interpretation of the market movement. And when we hit the 5 waves up, I had anticipated that we should make an ABC correction. Well, as you can see on the weekly chart, that construed of quite a bit of a time, almost a year and a half now so far that we've gone through since we made the top of the 5th wave. So what we're trying to guess from here now is, when will that 5th wave be over, looking at the more minor wave count to it, and potentially how far that it may end up going. So you can see on this chart how I try to represent the differences between what the actual markets are doing and the representation that Elliott wrote 100 and some odd years ago, where he felt that he could look at chart patterns and say with some certainty, upon this happening, the next most probable move should be X. So again, we see that we have 5 waves up in the live cattle market. We're anticipating 3 down. I believe we have the ABC correction, and that what we are currently in is the C wave of that. The C wave should break down into 5 subwaves, which I think we already have here, and by today's close at the low end of the December contract, which is what this is reflecting right now, it is well closed below the wave 3 low. It would take a close at the end of this week to solidify that, but currently it's already done. So this is the same chart. It's expanded out just a little bit more so we can see the waves a little bit more closely, with waves 1, 2, 3, and 4 perceived complete. And the reason I perceived are complete is because we have now broken this previous low right here. In the FATS, we've got this one hook right here in the 5th wave, because the spread between this 4 and this 5 should also have 5 smaller waves to it. Right now, we just got 1, 2, and 3, leading you to believe that there still could either be further price movement lower, or a wave 4 correction, which would be a small 2 or 3 week close higher, followed by another lower close. That would make 5 waves down in this particular chart. When you take it to the lesser degrees, then you can see the daily chart. And the daily chart, most all of this movement down through here that we can see on the weekly chart is this movement right here. This wave 4 high is this wave 4 high right here. And then we start to decline down from here, looking for a 5 wave sequence down. Although difficult to see in here, I'm assuming that a wave 1 and 2 is in here. This to be a wave 3 at this low. And right now what we've got is a very irregular wave 4 correction, where a portion of the wave 4 exceeded the orthodox low of 3. So when it made that low by just a minimal amount and started protruding back up again, I had felt that we were still in for another new low from that. So we have a wave 4 correction, and now we're in the 5th of the 5th wave. With that, we should terminate somewhere around 118 on the December contract, and I derived that from one of the, not necessarily rules of Elliott, but one of the thought processes of Elliott's, is after a 5 wave move is completed, the 3 wave move should pull back to the previous wave 4 of the same magnitude wave. This particular magnitude wave goes all the way back to 09, a 5 wave sequence up. So the major wave 4 being July of 13, that was 118 is that low. We're real close to it as of today's close, and I think we could actually meet that 118 low. Whether that's the bottom of it or not, it's kind of hard to say, but at least it gives us some idea that we want to be less short upon that happening than prior to. Because once it's made that 5th wave down and got near targets, the likelihood of it going back up or sideways tends to be greater than continual movement lower. This is the February contract. Shows the same thing. I've just got the trend channels drawn down there, and you can see that the volatility has taken the prices outside of the trend channel in both ways. But it's kind of tending now to stay more towards the lower end of the trading range after the spike up that we've had. We've got a couple of gaps in here. Gaps can always be a multitude of different factors in there. They can be breakaway gaps, exhaustion gaps. At this point in time, it might be a breakaway gap here just because of the congestion that we've seen. But I'm not going to call it anything just yet. This is the last one on the fat cattle. This is the April contract. They all have literally the similar patterns to it. The one nice thing is we're carrying a little bit of premium in the Feb and April, supposedly weather premium on there. So we've still got all of these charts that are still in this wave 5 move. I think we lack a couple of more dollars before completing that move on the weekly chart, and then we'll be very close to the low end. We may be, after looking at the way December traded today and was able to post a little bit of positive trading this afternoon before it started back down again, but that we may be close to intrinsic value, that level where you get enough people to say, I'm just not going to sell here, and enough people to say, I have some residual demand that I have to meet, regardless of what the price is, even though I may think it's going to go lower, I have commitments to make, and I'm going to go ahead and buy that. So we may be looking at real close to intrinsic demand here. The feeder cattle have the best looking chart, in my opinion. It mirrors the wave count as closely as anything I've seen in a long time. And I've been very fortunate that by being able to see this and recognize this, hopefully I've been able to profit a little bit from it. But you can see the wave count shown by Elliott and the major wave count shown on the feeder cattle chart. And they have exceptionally close resemblance to one another. So at this point in time, we've cleared out the 5-wave. We need an ABC correction. It was the initial move down. It was the wave B that I foresaw to be the selling opportunity. And now we're moving down in this 5th wave. Unlike the fats, the feeders have a little bit more clear chart pattern to them. And we break it down into the next degree, into the intermediate degree. And we can see from the wave B high to the wave C low, we have 5 waves down. That C wave should consist of 5 waves. Well, we've got those 5 waves right now. What we don't have is a completion of the 5th wave here. As we move it down into the daily chart and we get into the minor degrees, we're working on this wave 4 to this wave 5, which represents this wave 4 in red and this wave 5 in red. We can see there are 5 subwaves. My count for the 5 subwaves are in the purple, 1, 2, 3, 4, and 5. And we actually have 5 waves down. What it kind of looks like, though, is that there might still be another wave 4 and 5 of the most subminor waves before we complete this. I won't necessarily hold it true to the point that it has to do that, because my wave count could vary right up here. If it varies any right up here, and maybe this wave 4 actually terminated where I have the wave 2, then we'd have to go down to an hourly chart to be able to view the data that would be so small that you're not going to be able to see it on a daily chart. So go down to an hourly chart. It's probably a little real nitpicking down there to try to get that close to it. So if you've read anything that I've written, you've known that for the last 3 or 4 days, I've tried to urge people to not participate in this market. If I am wrong just a little bit and we're bottoming out in here, the knee-jerk reaction up could take us clearly back to 165 before you can bat an eye. If it doesn't, I still don't have that wave complete as I have it drawn right here. I still haven't met the 148.70 target yet either. So those 2 factors keep me from wanting to be overly friendly just yet, but know that I am not overly bearish any longer. And the greater the news, the more bearish the news gets, after all of this is transpiring, kind of leads me to believe that the noise here at the bottom is elevating. And that does sometimes have a tendency to have some bottom picking reflections to it. So this is the March contract. Same situation. This is just the bar. The bar chart shows all the noise of the up and down through the day. But say you can see the pattern right here, the wave 1 down, 2 up, 3 down, all of this to be a 4. But from the termination of this, we have the new lows. So I'm not as concerned about it being in a 5th wave. I think it is the 5th wave. But terminating it is very difficult right in here because we don't know whether it's going to stretch out a little bit further, whether it's going to hold tight up in here. But anywhere in here, when we start to see these lows be very, very close to one another, it kind of leads me to believe that we're having a more difficult time pushing it that much lower. Again, intrinsic value. Because once you get through with the poor production practices, and I say poor, and I don't mean that as far as being poor, but we know that growing cattle and increasing the weights increases production to where we're only down 3% for the year on total beef production on a 7 to 7.5% fewer animals slaughtered. We're still producing a lot of beef. And we've had consumer palate changes. We've had all kinds of changes within other proteins, competing proteins, that, and with the grocery store still having retail beef prices up at the upper end of the trading range, there is still some resistance from the consumer. Two things: with the consumer already having lowered consumption, the thought might be, well, what if they increase consumption just a little bit? Also, with this fifth wave nearing a terminal end, and knowing that expansion, although has probably increased the herd size to a small amount, I don't believe it has increased anything on the physical production side, the actual meat that is being killed and produced right now. I don't think expansion is having an impact on that. But clearly, we've had some expansion and we have had some increase in the herd size, but no major increase as far as beef production from those. So when we get into the spring of this year, I don't think there's going to be any more great size of new cattle from expansion to be around. I think what may still be around is the same thing: producers just trading amongst themselves in the different sectors for the number of available cattle. That number of available cattle is very small in the private sector. I believe that vertical integration has a significant control over a large percentage of the cattle. Therefore, the prices for them do not fluctuate as greatly as what they do for the amount of cattle that are available on the open market. The cattle that are available on the open market may or may not be as desirable, or may not have the capital expenditure up underneath them to hold them. So vertical integration is going to play an even larger part now that capital has become a very important role in the markets today. So this is all the minor degrees that we've got, and this is what we're looking for, is a termination of the fifth wave and what to anticipate next. So the fundamental view that I had this summer, late spring and early summer, was that we were going to have this C wave, and that traders were going to be buying up a lot of cattle in hopes that we would return back to the $240 price range again. It didn't happen. I anticipated the C wave, and it came down. It just happened to work that way. Assuming what the next move is going to be is significantly more difficult, because I'm not real sure that the next situation has begun to evolve yet. We have not completed this situation yet, so I'm not real sure that we can foresee the next situation, which leads me to believe that upon this completion, we may rally, and we may rally $10, $20, $30 at the most. But what we will do is we will do it in a very volatile and very sideways range. So you may spike under some kind of weather conditions, something short covering that initially makes the top end of the range. Maybe back to 167 where we just fell from, maybe as high as 187 where we fell from the top of the wave 4. Either way in there, though, you're going to spend a lot of time trading sideways, because this will take several months to continue to work out before you relieve a lot of the financial issues that we have and are able to get spring back in the air, get a little grass growing, and get traders out there that want to own inventory again. So these are the headlines that we saw most of last week and this week. Oil prices fell sharply Thursday amid expectations the powerful oil collective OPEC will decide against intervening in global markets by cutting production levels. What I'm getting into next is the low interest rate environment that we have seen has increased the infrastructure to produce at an exponential rate. Although I feel certain that we would have increased infrastructure regardless of whether we had the low interest rate environment or not, I don't think we would have done it this fast. Also, if you know where the prices of commodities were when the major portion of this expansion in infrastructure took place, we were $80 plus in crude oil. We were $7 plus in corn. We were $9 to $12 plus in beans. We were between $160 and $245 in feeder cattle when we began expansion in earnest. We were between $150 and $170 in fat cattle in expansion. So not only was it the low interest rate environment that provided the capital, but the price also provided the incentive to do that. So we've got still quite a bit. This is what a low interest rate environment looks like. As bonds move higher, the rate of interest moves lower. So the infrastructure that we needed in order to increase mining, increase drilling, increase grain production came from the low interest rate environment. It was helped tremendously by the price increases that we saw on there. So I think that we are still in that environment. However, the two new lows set yesterday and today in crude oil leads me to believe that we are very close to the lows in here. So in this low interest rate environment and the increase in production, we can already see these are rail car loadings, and we can see 1 year over the next how much all of the transportation of goods have declined. That is part of demand. Not only do we have oversupply, but we have lower demand. Regardless of why we have that lower demand, whether it's employment, wages, anything you want to tack it on to, we still have less demand. We tend to seem to have a significant increase in the cost of living expenses through our health insurance and other increases of finished goods, because everyone is trying to have to raise prices a little bit to make the ends meet. Well, we can see the toll that it's beginning to have on all of our movement within the U.S. This is across the world. These are the Baltic Dry Index measure rates for shipping containers. So this is what we ship across the country, across the seas, and we can see that it is right down at the low end. So we're at an economic low point of commodity movement. Some of it is because of oversupply, some of it is because of lack of demand, but the combination between the two has put us in a very low priced commodity environment with very high supplies. This is the crude oil. We can see that all throughout 12, 13, and 14, we were well above $90 a barrel. Tremendous infrastructure was built. The Sands pipeline was completed, and all of a sudden we dropped sharply in crude oil. Note the five-wave patterns, the same C wave is what we're looking at the feeder cattle, because these are major moves in the market. We have our from 4 to 5 count. There are 5 subwaves in that, and we even have 5 minor waves in this 5th wave. Whether it is complete or not, I don't know, but somewhere between 0 and 3690 right here, we're going to find intrinsic value. That place where Exxon, me, you, anybody out there has to have the product we're going to buy, because we have to go here, we have to go there, we have to heat, we have to cool, whatever our energy need is, it's kind of a have to do. So that intrinsic demand where there is consistent buying from is somewhere between 36.90 and 0. Where that is, I don't know. But knowing how volatile crude can be, and under some of the situations that we're in, to want to lock in some of that while it is down here might not be a bad idea. This is gasoline, and we can see that it has not had the same decline as what crude oil has, but it's declined quite a bit, and it seems to be holding a little bit better than what crude oil and diesel fuel is doing. Maybe $1.20 is intrinsic value for gasoline. Don't know, but it sure seems to be that way. It seems to have a very difficult time getting below $1.20. This is the diesel fuel, and this is probably what most of you will be interested in. So it's had no good demand. It continued, and even today set another new contract low. This chart was made this morning, so it has set even lower lows than the 127.35. Whether it is complete or not to the downside, I think from this low in August to probably this high right here in October is all of the wave 4 correction. And then maybe the wave count starts down with wave 1, 2, 3, 4, and then we're in 5. So for those that are looking to book diesel fuel for this spring, maybe even through the summer, one might want to consider looking at this market and owning some kind of upside protection right after the first of the year, just before the first of the year, but sometime before or while we are at these lows. This has been a relatively low volatility market. Remember, volatility is measurement of up and down, not up or down. Therefore, this market's been coming down pretty slow and steady for several months. The volatility is quite a bit lower in this market than some of the others, especially cattle. So we'll move on to the dollar index. We have a four total. We have meats, energies, currencies, and corn. So we're in our currencies now because I've mentioned this quite a bit because it has become important. Because as you can see, from 04 all the way to 14, it wasn't important. It declined all the way to 08, and then from 08 to 14, it stayed completely sideways. If you were transacting business with any country that you had to swap a currency for, your exchange rate was fairly steady for long periods of time. Therefore, it did not have the same impact on commodities as what it does now. Now, moving above the 08 and 10 levels, we are at price exchange rates that we've not had to deal with before. Those exchange rates vary between individual currencies, but the dollar index represents a basket of several of those currencies. The euro currency being weighted the most at 57.6%, then the British pound, the Japanese yen, the Swiss franc, the Corona, and one other market, the Canadian dollar, is in that mix. So Canada being a big trading partner with us, Australia being a big trading partner, one may want to look at the individual currency of it rather than the dollar index. The Australian dollar is not in the dollar index, so it doesn't have an impact to it. But when you look for the currency exchange rate, either what an Australian or Canadian is going to pay to be able to buy our dollar, to buy our goods, or we sell to Canada or Australia, what those dollar differences are. They can make a significant difference in a second or third party risk to the individual importer or exporter. So although you or I, because we have no exchange rate, when we buy corn for $3.80 a bushel, we pull $3.80 out of our back pocket. If we were to go to Australia and buy $3.80 worth of corn there, it would only be $3.60 or 50 cents a bushel for the corn there because of the difference in the exchange rate. So the exchange rate is very important to a lot of import exporters, especially now since we've begun importing significantly more beef from New Zealand and Australia to try to help up with the deficit that we've had over the last couple of years. These are the individual currencies. This is the euro currency here in the top left-hand corner, the British pound, top right-hand corner. Here is the Canadian dollar, the Australian dollar at the bottom. So you can see the Australian dollar, that's the exact exchange rate to the Australian dollar. If you were to hand them a $1 bill, they would give you 71.9 cents or 72, they would give you 128 of Australian dollars. If they were swapping it for Australian dollars, they would give the US $1 and they would receive 72 US cents. Same thing in Canada, because Canada is a big trading partner with us. So the same thing, as their product, as their currency goes down, it makes things in the US more expensive, and when they come to the US to buy it, and when the US goes to Canada to buy things, it makes it less expensive. And off to corn to finish it all up. Corn's already had a 5-way move down. It could fool me, and it could move another great big 5-way move down. However, there's some big differences in corn than in the other markets. The amount of total livestock on feed around the world keeps me thinking that corn has found intrinsic value. The ability to trade sideways and not exceed $3.50 a bushel for over a year leads me to think it's found intrinsic value. What corn doesn't have is a reason to rally. We are sitting on large stockpiles of corn, and we have an ethanol mandate that, although was increased, may be on a little bit more shakier ground than what it has been before. Corn needs something to make it go higher. I think it would be very difficult unless we had another significant move in the US dollar that would make corn that much more expensive to importing countries, that it's going to continue to trade right around in this area until we get towards the first of the year. And the very first thing I'm going to be thinking is production cuts. Production cuts in oil. We saw OPEC didn't cut any, but how about our U.S. grain farmers? Well, our U.S. grain farmers began to cut production in 2016 to help offset some of the input costs that they're going to have to be faced with. Will they employ some kind of poorer production practices? Will they skimp on fertilizer? Will they skimp on weed control, pest control? Will they not plant the lesser yielding ground? Whatever the case may be, I would anticipate a cut in production in some ways. With the El Nino ending and the La Nina coming up, I've heard several different weather reporters suggesting that this could be a very interesting year for 2016. Years that end with a 6 have a tendency to be some drought years that I have heard. So it has a good situation. What it doesn't have is any reason to move just yet. If you will notice, again, it is a little volatile because it's been going up and down. But the range from which it's been going up and down has shrunk considerably in the last 4 months. I think that the volatility premium on the options have declined significantly, putting them very close to fair market value. That means that regardless of whether you win or lose on the option, you haven't paid too much for the option. It is not overinflated, similarly to any feeder cattle or live cattle option that you may trade. You can clearly see the option volatility in that by the increase in premium. So corn needs something to move it up out of here. If you look at from the red wave 5 here to the wave 1 here, this is very similar to what I anticipate cattle, feeder cattle and fat cattle to do upon completion of this 5th wave. They'll make an initial move up, however high that may be, and then they will plane out and trade sideways for several months until we can finish this fundamental situation up, that we are right in the last part of it. So does it take another 2 weeks to finish it up, another 4 weeks, 6 weeks to finish it up? I'm not sure, but this is a very light pattern of what I anticipate fat cattle to do and feeder cattle upon completion of this 5th wave. So we've got corn, we got currencies, we got crude, and we got cattle. They all seem to be in 5th waves. The currencies, a 5th wave to the upside, commodities in a 5th wave to the downside. A great fundamental reason for the commodities to be down. We increased infrastructure to produce those commodities. We increased that infrastructure at a point where the price was very conducive to do so, and we overproduced. It doesn't matter what we did, we overproduced. And we overproduced it in a time when our economy is not the best, where consumers are going to go out and spend more or have increase in disposable income or an increase in discretionary spending. They haven't, and so therefore the supplies overcame the demand. I believe that as we are fixing to find out on the 16th of this month whether the Fed will increase the rates for the first time, and we move from a low interest rate environment back to a higher interest rate environment, probably not overnight, but clearly we could start it back, then as the infrastructure begins to cut back, we plant fewer acres of grain, we leave more of the wells sitting idle, we don't increase our mining by any amount, and we don't increase much of anything. We continue with maybe 6 to 8 months of continual production cuts. When the production cuts meet headlong back into the intrinsic demand, and somebody wakes up and says, you know what, I need something, and the call goes out to produce, we will no longer be in a low interest rate environment, and liquidity or capital could either be exceptionally hard to find at lower levels, or not lower levels, but exceptionally hard to find, or the price of it may be higher, therefore keeping expansion from increasing at the same pace as what it has before in times past. So those are kind of the things that I'm looking at. You've seen a little bit what I look at on the Elliott Wave. You kind of know the premise of what I'm looking at for the next 4 or 5 months in cattle and for commodities in general. in my opinion, we are fixing to go from a really, really gluttonous oversupply time frame to potentially something of very short supply, depending upon how the money flow continues. We have a tremendous amount of money out there from the stimulus package that is still out there and floating around and can move in various different directions. If some of that money tends to move back into commodities once production begins to be cut and we reduce the supply-demand factors back more towards heavily weighted to demand, that money could flow into commodities. So that's what I'm looking at. I certainly do appreciate you taking the time to be with me this afternoon. I will open up the floor to questions. If you will see on the screen now, there is a question box that I am dragging out. And that if you would like to, here we go, ask me any questions, please feel free to, and I will answer them out loud there. And if you can't, you're more welcome to call too. You can call, my toll-free number is 877-863-2206. So feel free to call and I'll be glad to answer anything, and I'll keep it open for a few more minutes and see. I had one individual ask earlier about heifer retention for this spring. Expansion has been running at full steam. If you can imagine what snails look like racing, that's how fast expansion really moves, but it is at full steam. We can clearly see that the heifer retention has been phenomenal through the heifer kill. So maybe sometime this spring we begin to see a little bit of pulling back from expansion. I don't know at what percent, because I don't think cow-calf producers are in near the consequence trouble from this price decline as what the other sectors that have shorter time frames to have to deal with these cattle are in. But heifer retention for this spring, if you just think about it from the money standpoint of it, and it having been in place for 2 full years now, I would say that you will see more heifers go into the kill cycle than into the breed cycle for the first half of 2016. I don't know by how much. That will potentially make for more cattle to be placed on feed. Not a great deal more, but more. But what it will do is it should keep the expansion from moving one direction all the way without any kind of breakups to it. So with some kind of breakup that we've got to it, this may be the very first setback in expansion. So we've got another question here, and this question is, do you see feedlots not getting cattle as big for slaughter? As long as the packer wants them that way, the feed yard will keep them that way. I believe that the packer, if he begins to go into the red and is suffering, he will instantaneously say, don't bring me any more big cattle. I don't want them. So I believe that the feed yard is not in as much control of that as is the packer. The packer is the one saying, bring us all the inventory that you can. I can sell it for a profit. That's what he's saying. So the feed yard, I think, does not have as much control over that as what maybe the packer does. And until the packer begins to say, I need you to cut some production there, then no, I don't think the weights will go down any just yet. So our next question is, let's see if I can blow this up where I can see it a little bit more. Chris, I need some help. I can barely see these questions. Can I make that bigger where I can see the whole question at one time? Just like that. Yes. Perfect. Thank you. Okay. Okay. Could a big tariff imposed on U.S. due to any reason, negative ruling on the COOL, bust away pattern below 148? I do not know. I do not know enough about COOL or the inner workings of it to know what impact that it may have on the market. I apologize for that. I probably should, but that is something that I really don't know. I think what might push feeder cattle below the 148 level would be more of a for marketing again, I believe that the time frame that we're in from now until the December the 18th, which most sale venues will close after that, is exposing issues that we thought we had gotten rid of. So we thought we had gotten rid of a lot of the big cattle that were slaughtered. They're still coming. We felt that we had placed a lot of feeder cattle, therefore there wouldn't be near as many to market in December. They still seem to be coming. So the short time frame is exposing issues that we felt had been dealt with. So how many more cattle there are to market in December will be make a much more greater impression on the below 148 than what might be. Are there call options available for the crude oil? Absolutely. There's call option, put options on crude, diesel, and gasoline. Crude oil is 1,000 barrels per contract. Gasoline and diesel fuel are 42,000 gallons per contract. Thank you, Chris. Great information for a beginning trader like myself. Very informative. I appreciate that. Chris, don't you think also copper fall is coming to an end? What you must said should be true for the copper as well. Absolutely. Any kind of industrial metal and energy, which I think they kind of go hand in hand, because if you're going to build something, you have to have the copper for the electricity, and you have to have the crude for the energy to be able to produce. So yes, I think that mining will slow as well, and that copper will be finding a bottom. Most all of these markets have a very similar five-way pattern to them, and what we're working on is just the final throes of that five-way pattern. Is there a way for me to rewatch this? Yes, in 2 to 3 days, we should have this on a platform where you can either view it online on my website, or we should be able to mail it to you, one of the two. But yes, it will be made available after this. What is the biggest driving factor for Americans not having surplus income, i.e. not buying surplus goods, buying meat or discretionary income? My opinion is healthcare costs. Healthcare costs are phenomenal. If you've read my commentaries for any amount of time back during the summer, I believed wholeheartedly that if we could get gasoline prices lower, our economy would have exploded. What I did not realize and failed to realize was that for every time a savings comes along in anything, be it meat, gasoline, or anything, it went towards another necessary expenditure. And healthcare insurance premiums tend to be the largest increase of any kind of capital expenditure per household for this year. No commodity has gone up in price. Not many services have gone up much in price, except for healthcare insurance. So I believe that because of how significant those increases are to a majority of people out there, that is the reason why. I believe that the employment rate is true for what they say. We have 5% of the people that are willing to work working. We have a tremendous amount of people out there that could work if various things were to happen and increase our workforce out there. So we're not increasing, the amount of wages that we increase is still not increasing employment, the kind of employment that we need to make our economy bigger and stronger and give those individuals the ability to purchase those additional goods. Our next question, how would you like to acquire feeders? How would you like to acquire feeders to protect yourself? Physical inventory, futures, options, combination of the above. If I have feeder cattle right now and I am trying to protect them, I would do the minimalist that I could. I would stick with options because options give you limited risk for unlimited profit potential. I would use that option strategy depending upon how much protection I needed to an odds and percentage play. Due to the strike prices that you may choose and or premiums and not getting 100% protection as in a futures contract from the very next tick, you might have to buy more than one option or a series of options to give you that same 100% risk protection that you need that a futures contract would. So from the aspect of that, I think that I would use options more than futures, and I would do it to a very minimal amount. I would only do it to what I just had to meet at this point in time. I really feel that after the first of the year, similarly to any kind of pain, once you get the situation resolved, as painful as it may have been, that situation is over with, and you have to start looking at the future. You got to put the past behind you. You got to start looking at the future. And that's what the cattle industry is going to do. I have no doubts of it whatsoever. They're the most tenacious group I've ever seen. So to think that we are going to just plummet in cattle and not trade cattle any longer is in no way, shape, form, fashion. I believe that come the first of the year, as this current situation is addressed and ratified, we will begin to look at supply issues very similar to what we have for the last 2 to 3 years. All that would be needed is a small increase in demand to start chewing through that. Production cuts. See if the packer, as we stated before, if that packer starts losing money, he will start cutting production. That cut in production will be the sound off to the feed yards to not raise them to the same weight limits as we have before. Next question. Where do you see fertilizer prices going? I do not know. I do not track fertilizer prices, so I'm unable to answer that question. I do know that there are relationships between crude and natural gas, and that fertilizer prices have not followed the decline the same as. Again, that kind of tells me that what these companies are doing is they are making the margin by either keeping retail prices the same or increasing them as commodity prices are going down. The cost of everything, for every company that provides insurance for their employees, they have to make up that difference somewhere or another. For every penny or dollar that the commodity drops, they have to sell that much more in order to make the same amount of revenue as they did at the previous price. Thanks, Chris. You are always enlightening. It will be an adventure in 2016. How many producers that background cattle are you seeing that are staying hedged? My clients have already sold their cattle and pretty much all out of their hedges. I have attempted to steer most clients away from doing anything at this point in time. I think there are still clients. I still have clients with hedges on, of course, because they have to have them. I think it's a have-to situation, and I'm going to take this 1 minute to add something to this. Marketing with futures has the ability of hindsight. When you market in the cash market at present, there is no hindsight. There is no, I should have, could have, would have, I could have done better, I should have sold this price. There is none of that. But when you use a substitute sale or purchase with the futures or options, you got hindsight in there. And that hindsight is very, very difficult to overcome. So when I'm looking at traders that are staying hedged, they are doing it from a substitute sale or purchase stance. They are not concerned if they make or lose money off the futures position, or if they make or lose money off the cash position. They don't have a position. If they bought options or they sold futures, they are flat the market. They are long the cattle, they are short the futures, they are flat. You will see hedgers stay that way until the physical inventory is transferred. So hedgers and speculators that do the same, they may or may not still be hedged. People that are hedged that do not account for hindsight and are using the futures to market their product, either through the physical or through a substitute sale, they're staying with them. If it ever starts raining again in Australia and they stop the mass liquidation of cattle, how could that affect our export markets? Well, it won't affect our export markets in any. It'll affect our import markets as we import beef from Australia. So if they begin to slow down on their kill, clearly it will slow down on our purchases. They will still have to have enough inventory to meet their own domestic needs, and it will shorten the amount of supply that they have for exports. So our exports markets won't be affected any by it, but our import of beef from Australia should be affected to an extent, and all that will just depend on how quickly they begin to or want to rebuild their herd size. Would you recommend marketing feeder calves yet this year, or if a producer is financially able, hold them into the new year? That goes back to our poor marketing practices that if the cattle are ready, they need to go. Putting on more weight and keeping them for longer has put us into this position to begin with. I'm not real sure that keeping them longer is going to get you out of this situation. At best, I think what you might see is at the termination of the fifth wave, you get an initial rally up. That initial rally may not be much more than $10 or $15 higher than where we are right now. We don't know how low we're going to go first before we make that rally. So if one were to view it from a risk-reward relationship, why not eliminate unlimited risk, sell the inventory and be done with it? And if you had to continue to own inventory, own it on paper, on call options. You have transferred unlimited risk exposure to limited risk exposure with still 100% profit potential above the strike price and premium that you pay for the option. It won't be 100% as what if you had the physical inventory, but neither will it be 100% if the price continues to go down. Are other producers seeing excellent margins buying at these price levels and forward contracting the cattle in a backgrounding situation? Are other producers seeing excellent margins buying at these price levels and forward contracting the cattle in a backgrounding situation? Not that I know of. I believe that the hedge today is buying the cattle cheaper. We're in a down market. Cattle have been going down. I want to buy low and sell high. So my hedge, instead of buying low and then selling lower in the future, I want to buy low here in anticipation of the future being higher. So I don't think that is being done right off the bat. What I do think is being done is that packers and feed yards are using the positive basis to their advantage to acquire physical cattle that are under duress, and when that cannot be done, they dip in and they buy what they need on the futures market at $10 to $12 discounts. In 45 days, when January expires, one of four things will happen. The cash goes to futures, in which they are now able to buy their physical inventory for the 10 to 12 cheaper, and they've not made or lost anything off the futures because of the spread. Futures go to cash. They're not able to buy physical inventory any cheaper whatsoever than what they were, but they just picked up $12 on the narrowing of the basis by the futures moving to the basis. It might go cash and futures way below the whatever price level they are today that they are hedging at. Regardless, they still bought them on the futures. If they lose on the futures and lose on the cash still going down, they still got a $10 to $12 spread between the two. They really have picked up cattle still $10 to $12 cheaper. And the last thing they do is meet in the middle. Cash goes down a little bit, futures go up a little bit. Either way, I'm still able to buy the cash end of it at under the duress issue a little bit cheaper, and I got a $4, $5, $6, $7 profit on the future side of it. So in a positive basis like this, it is very, very advantageous to the purveyor that is using futures and options that knows they're going to be buying cattle. They know they're going to be buying cattle regardless. So how I buy them is very important to me. So I think that's what they're doing. Let's see. Let's go all organic and see how much less food there is on the world market. That's a very truism statement there. Given the volatility in feeder futures, would short-term cattle keeping nothing over 90 days and staying out of the futures be a good way to go? seems like an awfully fast turnover, 90 days, to put weight on them. I think at this point in time, it's not going to be a bad deal to do that. If you can keep your marketings current on there and not try to hold them for any particular movement, but you've got to have some kind of margin already priced in there, whether it's through input cost or just the purchase of the animals alone. I think you need a slight bit of margin in there before I would do that. That looks like about all the questions, and it looks like I've talked for almost an hour. So I don't want to keep y'all any longer, and I want to tell you how much I sure do appreciate all of you sticking around, and I certainly do appreciate the questions. Anytime I can do something for you, never hesitate to pick up the phone and call me. My toll-free number is 877-863-2206, and this is Chris Swift signing off. Y'all have a great night. Thanks.